According to International Business Times, Palantir Technologies has entered another bout of volatility, with shares sliding again even as the company continues to report some of the fastest growth in large-cap software. In this episode, we are going to unpack what is really going on beneath the latest share price weakness, and what it may mean for investors and market watchers who follow PLTR. According to International Business Times news, Palantir stock recently traded around $126 and change, down modestly on the session, extending a decline that followed a sharper drop the previous day. That earlier move was part of a broader pullback in richly valued technology names, where investors seemed to rotate out of high multiple software into safer or cheaper corners of the market. Peer names like Salesforce, Oracle, and ServiceNow also moved lower, underscoring that this is not just a Palantir story, but a sector-wide risk sentiment shift. International Business Times mentions that many analysts are pinning the recent pressure more on macro factors and valuation concerns than on any sudden deterioration in Palantir's underlying business. For stock investors, this distinction is critical. When a stock falls because earnings are missing, guidance is cut, or a product fails, that is fundamentally different from declines driven by macro worries, interest rate expectations, or a broad de-risking of growth assets. From an investor's perspective, the setup around Palantir is a classic case of a high-growth, high-multiple name that is extremely sensitive to changes in market appetite for risk. When the market is optimistic and willing to pay up for long-duration cash flows and artificial intelligence exposure, PLTR can soar. When sentiment turns risk-off, these same attributes become vulnerabilities because valuation multiples compress quickly. Let us start with the stock's recent trading profile. According to International Business Times, Palantir has been one of the most volatile large-cap technology stocks this year. Shares are trading materially below their all-time high above $200, a peak reached late last year. The stock even fell into the low $100 range in late June before staging a rebound of nearly a quarter from those lows. Even after that rebound, though, the stock price remains far under its highs, demonstrating just how violent the swings can be. For investors, this kind of volatility cuts both ways. On the one hand, it creates opportunities for traders and long-term believers who are willing to step in during periods of panic or forced selling. On the other hand, it can shake out weaker hands and make it difficult for newcomers to establish conviction. High volatility often amplifies emotional decision-making, which in turn can create mispricings in both directions. International Business Times points to several factors behind the latest stretch of weakness. First, there's the sector-wide software sell-off and institutional profit-taking. When a stock has previously run hard and become a consensus winner, institutions will naturally look to lock in profits when macro clouds gather. Palantir, after a major run, has become a prime candidate for that sort of rebalancing. Second, the stock's elevated valuation multiples have made it more sensitive to swings in interest rates and growth expectations. High multiple names effectively discount many years of strong growth. When growth is rewarded, that can lift the shares dramatically. But when investors get nervous about inflation, interest rates, or geopolitical risk, the discount rate used to value those future earnings rises, and the shares can re-rate sharply lower. Third, International Business Times highlights insider selling. In particular, recent disclosed sales by Chief Technology Officer Shyam Sankar, who sold a meaningful block of Class A shares worth tens of millions of dollars, have added to short-term selling pressure. For many retail investors, insider sales are often viewed as a signal that management believes the stock is fully valued or overvalued. From a sophisticated investor's standpoint, insider sales must be interpreted with nuance. Executives often sell for reasons unrelated to the company's prospects, such as diversification, tax planning, or personal liquidity. That said, heavy or repeated sales near peak valuations can reinforce an existing narrative that the stock has gotten ahead of itself. When that narrative is already present, as it is with Palantir, even routine sales can act as a psychological catalyst for broader selling. Another major theme in this news is competition and the narrative around artificial intelligence rivalry. According to International Business Times, investor Michael Burry, famous for correctly predicting the housing crash in the late 2000s, has reportedly taken a large bearish position against Palantir. Burry has argued that Anthropic, a leading artificial intelligence developer, is encroaching on Palantir's business and, in his words, is eating Palantir's lunch. That is a strong statement, and for investors it raises a fundamental question. Is Palantir's competitive moat in enterprise AI and government analytics truly under threat from general-purpose AI companies like Anthropic, or is this more of a headline-driven scare story? Wedbush analyst Dan Ives, for example, has pushed back hard, calling the idea that Anthropic is a serious existential threat a fictional narrative. He continues to defend Palantir's position in enterprise AI. From a strategic viewpoint, Palantir's value proposition is not identical to that of a frontier model lab like Anthropic. Palantir sells platforms, integration, security, and domain-specific solutions that are deeply embedded with customers, especially in defense, intelligence, and regulated industries. Anthropic focuses more directly on foundational AI models and tools. There is overlap, particularly as enterprise customers experiment with many AI vendors. But Palantir has established deep, sticky relationships and operates in sensitive sectors where trust, compliance, and security matter at least as much as raw model sophistication. For investors, the key is to distinguish between narrative risk and true competitive risk. Narrative risk is about how stories move stocks in the short term. A prominent short seller coming out with a bold claim about a hot name like Palantir can drive volatility and accelerate profit-taking. But long-term returns will still depend on whether customers continue to adopt Palantir's platforms, renew contracts, and expand usage. The data in this article suggests that, at least so far, demand remains robust. This brings us to the company's fundamentals. According to International Business Times, Palantir's operating performance has been exceptionally strong. The company posted its fastest revenue growth rate in its history as a public company. First quarter revenue surged roughly 85% year-over-year to about $1.6 billion. Net income approached almost $900 million, giving the company a net margin above 50%, and adjusted free cash flow was also close to the billion-dollar mark. Those are remarkable metrics. Revenue growth in the high double digits combined with such strong profitability and cash generation is rare in software, particularly at Palantir's scale. Many high-growth software names still burn cash or operate at razor-thin margins. Palantir is showing that its business model can scale with strong operating leverage. Management has guided for full-year revenue in 2026 that would imply growth of more than 70% over 2025. For long-term investors, guidance like this reinforces the central bull case. Palantir aims to be not just an AI and data analytics leader, but also a highly profitable platform company with both government and commercial exposure around the world. However, all of this brings us back to valuation. International Business Times notes that even after its recent pullback, Palantir commands a market capitalization north of $300 billion, against trailing revenue of about $5 billion. That puts the stock at around 60 times trailing sales, a level that many traditional value investors would instinctively avoid. A research firm named Rebound Capital, cited in the article, believes the stock is still expensive. According to their analysis, Palantir trades at roughly 80 times next 12 months forward earnings. They also argue that the company often behaves more like a high-touch consulting firm than a pure software platform, yet still enjoys the premium valuation of an elite software business. This critique raises an important nuance. Palantir's solutions often involve intensive deployment, integration, and ongoing support. That can look, at least from the outside, like consulting. If a meaningful portion of revenue effectively depends on people-heavy, project-style work, then the classic software multiple may not be entirely justified. On the other hand, Palantir and its supporters argue that much of that work is actually part of deploying and scaling reusable software platforms, which can embed deeply with customers and generate high-margin, recurring revenue over time. For investors, parsing this difference is crucial. If Palantir is closer to a consulting firm with some proprietary tools, then a high revenue multiple might be fragile. If, however, Palantir is a platform company with sticky software and repeatable solutions, then a premium multiple may be more defendable, particularly if growth and margins remain strong. Beyond valuation and fundamentals, the news also touches on politics and regulatory risk. International Business Times mentions that Palantir has faced political backlash and fears of congressional subpoenas related to its expanding government contracting business. Federal contract revenue reached nearly $2.2 billion in the year following President Donald Trump's return to office, a jump of about 65% from the prior year. Commercial revenue more than doubled over the same period. For investors, heavy exposure to government contracts is a double-edged sword. On the positive side, government contracts, especially in defense and intelligence, can be long-term, large, and relatively resilient to economic cycles. They can anchor a company's revenue base during downturns. On the negative side, they bring reputational, political, and regulatory risks. Changes in administration, policy shifts, or heightened scrutiny in Congress can affect contract renewals or delay awards. Palantir's close involvement with controversial areas like surveillance and military technology inevitably draws attention and criticism. Understanding this risk means acknowledging that Palantir is not just a typical enterprise software company. It operates at the intersection of technology, national security, and politics. That positioning can create both tailwinds and headwinds, and it may inject additional volatility into the stock when political narratives change. The article also highlights Palantir's ongoing momentum in partnerships and deal-making. According to International Business Times, the company has recently expanded its partnership with Nvidia. This new agreement focuses on integrating Nvidia's Nematron AI models for sovereign government deployments. When that announcement hit on July 1st, Palantir shares jumped over 9% in a single afternoon session. For AI-oriented investors, this Nvidia partnership is particularly significant. Nvidia is arguably the central player in the current AI hardware and ecosystem build-out. Being chosen as a strategic partner for sovereign AI solutions signals that Palantir remains near the center of the emerging AI infrastructure for governments. It also strengthens the argument that Palantir can act as an orchestration and deployment layer for cutting-edge AI, rather than being displaced by model providers. On top of that, President Trump's financial disclosures showed that he held at least a seven-figure position in Palantir and had recently bought more. That disclosure coincided with the Nvidia news and likely contributed to the rally, particularly among investors who follow Trump-aligned themes or interpret his personal holdings as a form of endorsement. International Business Times also mentions new commercial agreements, such as an expanded deal with Surf Air Mobility and a contract to provide the U.S. Army with its Foundry platform. The company has broadened its market presence with GNP Seguros, Mexico's largest insurer, and formed a strategic alliance with Rackspace. These deals illustrate Palantir's push beyond its traditional image as purely a government and defense contractor. For many years, the bear case was that Palantir would struggle to replicate its success in commercial markets or outside the U.S. defense ecosystem. The recent deals show continued traction in insurance, mobility, cloud services, and international markets. For long-term investors, this diversification can help de-risk the revenue base and support the idea that Palantir is building a global, cross-sector AI and data platform. On the technical side, sentiment remains mixed. According to International Business Times, Traders Union analyst Anton Karadanov notes that Palantir's shares are trading below both their 50-day and 200-day moving averages, which many technicians interpret as a sign of persistent weakness. He emphasizes sector-wide selling, profit-taking, and high valuations, arguing that there is little conviction for buyers to step in aggressively at current levels. Technical investors who focus on momentum and trend following may interpret this as a reason to stay cautious or underweight until the chart improves. Being below those key moving averages can act as a sort of gravity, making it harder for the stock to sustain rallies without a clear catalyst like earnings or major contract wins. On the other hand, another Traders Union analyst, Viktoras Karapetjank, takes a more constructive view. According to International Business Times, he points to record revenue growth, new international partnerships, and strategic deals with Nvidia as evidence of strong business momentum. He highlights raised guidance and expansion into AI as supporting a bullish long-term outlook, despite short-term technical headwinds. This split in analyst opinion is exactly what you might expect in a stock like Palantir. On one side, there are valuation-focused and technically minded analysts who see a stretch chart, lofty multiples, and recent insider selling. On the other side, you have growth and AI-oriented analysts who see exceptional fundamentals, powerful partnerships, and a long runway for expansion. Wall Street overall, according to International Business Times, remains largely optimistic. Over the past month, analysts on average rate the stock as a buy, with price targets that range widely from as low as around $70 to as high as $255. Pat Davidson has been among the more bullish, upgrading Palantir to buy after the Nvidia partnership with a target of $175. From an investor's perspective, this wide dispersion in price targets shows just how much uncertainty and disagreement there is about the correct valuation. In situations like this, your personal thesis and risk tolerance become critical. Are you comfortable paying a high multiple for a company that might transform how governments and enterprises use AI, with all the political and competitive risks that entails? Or do you see the current price as reflecting overly optimistic assumptions about growth, margins, and competitive dynamics? One final component in this news is the upcoming earnings report. International Business Times mentions that Palantir's next scheduled earnings is in early August, and investors are likely to watch this closely. Earnings will offer fresh data on revenue growth, margin trends, contract wins, and guidance. If Palantir can continue to post high double-digit growth with strong profitability, the bull case gets further support. If growth decelerates sharply or guidance disappoints, the multiple could compress more, and the stock could see another leg down. In practical terms, investors might consider several angles when approaching Palantir at this stage. First, position sizing. Because Palantir is volatile and richly valued, it may not be suitable as an outsized single-stock position for more conservative investors. Keeping it as a smaller portion of a diversified portfolio can help manage risk while still giving exposure to AI and defense software themes. Second, time horizon. The case for Palantir as a compounder rests on a multi-year horizon, not on months or quarters. If your time frame is short, the stock swings around macro headlines, politics, or individual analyst reports can be difficult to stomach. Third, thesis clarity. Are you investing because of government contracts and defense AI, because of commercial expansion and partnerships like Nvidia and GNP Seguros, or because you believe Palantir will become a foundational AI platform across industries? Knowing which part of the story you are underwriting helps you interpret new information. For example, if your thesis is mainly government-focused, then contract wins with the US Army or sovereign AI deployments with Nvidia are central. If your thesis is commercial expansion, then partnerships in insurance, mobility, and cloud become more important. Fourth, risk factors. Investors should explicitly acknowledge the key risks. These include valuation risk, where even minor disappointments can trigger large drawdowns. Political and regulatory risk, especially tied to surveillance and defense. Competitive risk from other AI and data platforms, including both big tech cloud players and specialized AI startups. And execution risk, in terms of continuing to onboard new customers, maintain margins, and scale deployments without slipping into low-margin consulting work. When you line up all the information from this International Business Times article, the portrait of Palantir that emerges is not simple. On one hand, you have spectacular growth, high profitability, and expanding global partnerships, especially around AI and defense, supported by bullish analysts and major investors. On the other hand, you have a towering valuation, significant political controversy, insider selling, and high-profile skeptics like Michael Burry arguing the competitive story is weaker than it looks. For many investors, this is exactly the kind of contested, high-uncertainty environment that creates alpha opportunities. If you can build an informed conviction when others are divided, and if that conviction turns out to be right, the rewards can be substantial. But it also means that Palantir is not a simple, low-risk investment. It is, instead, a high-conviction bet on the future of AI-enabled defense and enterprise analytics, with all the complexity that implies. As Palantir heads toward its next earnings report in early August, market participants will be watching not just the numbers, but also management's commentary around AI adoption, government demand, and competitive positioning. Any update on the depth of the Nvidia partnership, the traction of new international clients, and the pipeline for sovereign AI deployments will be especially important for refining valuation models. To wrap up, International Business Times offers a snapshot of Palantir at a particularly interesting moment. The stock is off its highs and unstable, yet the underlying business remains very strong. The AI narrative is both a blessing, by attracting investor attention and capital, and a curse, by amplifying volatility and scrutiny. Whether Palantir ultimately justifies its current valuation will depend on its ability to sustain high growth, defend its competitive moat, navigate political pressure, and prove that its business is more scalable software platform than bespoke consulting. Thank you for listening to this episode. If you found this analysis helpful and want to stay updated on Palantir and other market-moving tech stories, be sure to subscribe and follow the podcast so you do not miss future episodes.